Welcome back to Investing Talk Podcast. We are focusing today on one of the real standout growth stories recently, Shopify. I mean, it's just been on an absolute tear in the e-commerce world, logging roughly, 47% gains year to date. That's a blistering pace for a company this big. The stock closed October 23rd, 2025 at $162.64. And, with Q3 earnings just around the corner in early November, the big pressing question on everyone's mind, and really the mission for us today is pretty simple. Is Shopify a good time to buy now? Or, have those incredible gains already been priced in? Before we really get into the details, just a quick reminder, remember to hit subscribe, like this discussion if you find it useful, and maybe leave a comment below if there's a specific company you want us to look into next time. We really do tailor these discussions for you.
Yeah, absolutely. And our goal today is basically to cut through some of the noise, maybe the hype, and give you a comprehensive evidence-based answer to that exact question: should you buy? We're planning to look at it from, let's say, 4 angles: the recent catalysts, the last 3 months or so, the fundamental health, digging into those Q2 results, the short-term schedule, like earnings and the holiday reports coming up, and then finally the technical picture, and importantly, the risks involved. We need to figure out if this is a solid foundation for more growth, or if it's becoming maybe a bit of a high wire act.
I like that framing, the high wire act, because when you see gains like 47% in less than a year, there's always that worry, right, that you're jumping in just as things are peaking.
Yeah.
So let's unpack this recent momentum first. What's been driving it? Is this like genuine earned growth we're seeing, or is it just broader market sentiment lifting a popular tech stock?
It's probably a bit of both, but I'd argue the foundation is really solid execution by the company. On the macro level, sure, e-commerce trends are still strong, consumer spending's been surprisingly resilient, and that definitely provides a tailwind. But Shopify seems to be doing more than just riding that wave. They're actually outpacing a lot of their peers.
So it's not just the tide lifting all boats, they're paddling faster.
Exactly. That outperformance compared to sector indices, it really points to their ongoing innovation and, crucially, how they keep expanding their merchant ecosystem, both geographically and into new types of business. And if you trace the most recent surge, a lot of it goes back to the Q2 results they announced back in August. Those numbers confirmed the strong revenue growth was continuing, but maybe more importantly, they really highlighted progress on operational efficiency and scaling internationally.
Right, that shift in narrative from just growth at any cost to focusing on profitable growth seems to have really struck a chord with investors.
Absolutely. Proving they could manage costs while still growing fast, that set a really optimistic tone for the rest of 2025. And we can see that sophisticated investors seem to believe this momentum is real just by looking at institutional buying patterns. Several big investment groups significantly increased their holdings heading into the fall, which signals pretty strong conviction ahead of these crucial Q3 results and the holiday shopping season. That kind of institutional backing is a big vote of confidence in the business itself.
Okay, so that brings us back to that high wire analogy. Before we get too excited with the $162 price, we need to look at the numbers that are supposedly justifying it. Let's get into the fundamentals. How healthy is this business underneath all the price action?
Well, the fundamentals look exceptionally strong, and frankly, they have to be to support the kind of valuation we'll talk about later. Let's start with just the sheer size and speed of growth in Q2 2025. Revenue hit $2.68 billion. That's a year-over-year growth rate of 31.1%. That kind of speed, at their scale, is significantly outpacing most peers in the large software and e-commerce space globally.
Wow. Yeah, 31% growth at that size, that's really the definition of a market compounder, isn't it?
It is, and the gross merchandise volume, or GMV, that's the total value of everything sold across their platform, that also surged 30.6% year over year to nearly $88 billion. What's really interesting there is how it's growing. It's pretty well diversified, driven heavily by both international market expansion and a big pickup in business-to-business, or B2B sales.
Okay, let's pause there and connect this to the bottom line. They reported, $906 million in net income for Q2. How are they managing that alongside such explosive growth? Are they cutting back on future investments to show profit now?
It really looks like they found a better balance. The gross margin was solid at 49.3% in Q2, which shows they're managing their cost of goods sold effectively. And the company showed, impressive financial control overall, moving towards real profitability with that operating income of $291 million. Based on this trend, analysts are now forecasting the full year 2025 earnings per share, or EPS, at around $1.12. That's a sharp jump from the previous year, suggesting those operational efficiencies they've been talking about are actually kicking in.
And their balance sheet, you called it fortress-like earlier. What does that mean practically for someone listening, thinking about the risk?
Right, fortress-like. What I mean is it points to stability and financial freedom for the company. Their current ratio is 3.9. Basically, that means they have almost $4 in easily accessible assets for every $1 of short-term debt they owe. That's a huge safety cushion. Plus, their total debt compared to their equity is tiny, just 0.09. So this strong liquidity lets them handle broad market downturns better than most, and it means they can invest aggressively in R&D or maybe even make acquisitions without needing to borrow expensive money.
Okay, so the numbers are spectacular. But beyond that, what's the actual competitive moat here? Because, a strong balance sheet and fast growth attract competition fast from giants like Amazon or even smaller, more agile platforms. What makes Shopify sticky for merchants?
Yeah, that's the key question. I think it boils down to a strategic shift they've made. They're moving beyond just being a place to host your online store to really owning the entire transaction experience wherever it happens online. The sheer breadth of their ecosystem is becoming the moat. You look at things like the Shop app, the Shop minis, and especially the checkout kit they've rolled out.
Can you elaborate a bit on that checkout kit? That feels like a really key differentiator, maybe particularly against their biggest competitors.
It's fascinating, actually. What the checkout kit does is it allows large enterprise-level merchants to embed Shopify's checkout, which is known for being super optimized and high converting into any digital property they have. So think an app, a game, a social media feed. Shopify can capture the transaction value and the data from that sale, even if the merchant isn't hosting their main store on Shopify's platform. It's about being everywhere.
Okay. That's a crucial insight. So they're shifting from being just the online shopping mall to being the toll booth on basically every digital highway.
That's a great way to put it. Exactly. And then you layer on the AI angle. The integration with things like ChatGPT for instant checkout is making transactions faster and potentially boosting buyer loyalty. And their collaboration with Amazon for multi-channel fulfillment is also, frankly, quite brilliant. They're pragmatically using Amazon's logistics power to give their own merchants a huge leg up on delivery speed, essentially turning a major rival into a necessary partner in some ways.
Okay, so the fundamentals are clearly there, supporting the growth story. But timing is crucial in investing. Looking ahead, say the next 3 months, what should listeners be tracking closely? What are the key dates or events that could really move the stock price?
Yeah, investor focus is definitely shifting to the calendar now. First up, and most important, is November 4th, 2025. That's the Q3 earnings release. Consensus estimates are already pretty high, suggesting around 27.3% year-over-year revenue growth is expected. They really need to meet or ideally beat that high bar.
Okay, so that's the immediate potential volatility trigger. What comes after that?
The next big thing for sentiment will likely be December 15th, 2025. That's roughly when we expect their report on the holiday shopping season. This gives us critical, near real-time data on consumer demand within their ecosystem, and it acts as a pretty powerful forward indicator for Q4 and beyond.
And are there external factors outside of their own reporting that we should watch?
Definitely. We need to watch capital flows. December 20th, 2025 is a key date for major ETF portfolio rebalancing. If big tech funds decide to up their weightings in high-growth e-commerce names like Shopify, that forced buying could provide another technical lift to the stock. And then, looking into early next year, January 9th, 2026, is the deadline for institutional ownership filings. That will give us the full picture of which big funds were buying or selling during the busy Q4 period.
All right, let's shift gears slightly to the speculative side. The rumors and whispers that can sometimes drive really fast price moves separate from the confirmed news. What's floating around out there that could unlock growth maybe the market isn't fully pricing in yet?
Right, this gets into the speculative upside, which is, frankly, pretty important for a stock that's already priced for a lot of good news. Some of the chatter includes a potential high-profile integration with a major North American physical retailer, a brick-and-mortar giant. That could open up a massive new channel, blending online and physical inventory in new ways.
Interesting. Expanding that partnership model beyond just online players. What else?
Precisely. There's also persistent market talk about potential moves into fintech, either launching or maybe acquiring a broader payment processing or even a buy now, pay later type of arm. If they can capture more value from the actual transaction itself, beyond just hosting the store, that significantly boosts stickiness and profit margins. Plus, always expect more AI news. There are unconfirmed rumors about new AI-driven tools for merchants potentially being unveiled soon. If those tools really help merchants sell more or manage their business better, that offers more adoption and margin upside.
Okay, the overall narrative is clearly very positive, almost overwhelmingly so. Let's pivot to the charts, though. Technical analysis gives us a different perspective, more about market sentiment and trend sustainability. How did the stock actually look on the charts as of October 23rd, closing at $162.64?
The technical picture is robust, yeah. It confirms the strong, sustained uptrend we've been talking about. That closing price of $162.64 is comfortably above key moving averages. It's well above the 50-day moving average, which was around $148.84, and even further above the longer-term 200-day moving average at $122.57.
Okay, that big gap between the current price and especially the 50-day average, that points to really strong, almost vertical momentum recently, right? Yeah. But doesn't that kind of rapid climb also increase the risk of volatility?
It absolutely does. While the technical suggests the trend is still intact, traders definitely need to be braced for potential volatility spikes, especially around that upcoming earnings report. Our analysis suggests a likely bullish trading range for the next 3 months, maybe somewhere between $150 and $180, assuming no major market shocks. A sustained drop below $150, though, that would be a warning sign, signaling a potential shift in that positive sentiment.
Right. But as we always say, no investment is risk-free, especially when momentum is this hot and valuations are high. You mentioned the high wire act earlier. What are the key risks? What could realistically cause this stock to stumble?
The single biggest risk, the one that probably keeps analysts cautious even when they're bullish, is the valuation premium. It's just exceptionally high right now.
Okay, let's put some numbers on that. What exactly are the multiples we're talking about?
Well, Shopify is trading at a trailing price-to-earnings ratio of around 93, and its price-to-sales multiple is about 19.6. Now, to put that PS number in context, it means investors are currently paying almost $20 for every $1 of revenue the company generated over the past year. That is significantly higher than most of its peers in both software and e-commerce.
And that's exactly why the high wire analogy fits so well, right? It implies their growth has to stay nearly flawless. What happens to that multiple if they miss Q3 earnings, even by just a little bit?
That multiple contracts, and historically for stocks like this, it can contract very quickly and sharply. While you can argue the premium is justified today by that 31% growth rate and the improving profitability, any sign of a slowdown, maybe even just a deceleration to, say, 25% growth next quarter, could trigger a rapid re-rating of the stock as investors adjust their future expectations downwards.
Okay, what about internal risks? We saw the recent departure of the COO, Kaz Nekstation. It was framed as managed well, but are there any specific execution risks tied to that role we should be aware of, especially thinking about that operational efficiency narrative?
That's a really sharp question, and it connects directly. Nekstation was reportedly heavily involved in exactly those operational efficiency initiatives that helped boost margins and deliver that big Q2 net income number. So while the company says succession planning is smooth, any disruption in leadership, particularly in the teams focused on efficiency and execution, does introduce a genuine risk. If we see margins stall or even dip in the next quarter, you'd have to look back at that departure as a potential contributing factor.
And finally, just the general market risk.
Yeah, the standard disclaimer, but important here, as a high beta tech stock, Shopify is inherently more sensitive to broad market sell-offs, particularly in the tech sector, or any sudden shifts in economic outlook, especially around consumer spending. However, that strong, fortress-like balance sheet we talked about does provide a significant buffer against the worst kinds of systemic shocks compared to less financially sound companies.
So let's try to tie this all together for our listener who's trying to make that buy decision. We've covered phenomenal growth, strong fundamentals, a widening moat, but also very real valuation risks and potential execution hiccups. What's the overall takeaway?
Looking at the totality of the analysis, the overall investment thesis seems to hold a strongly bullish rating, maybe a 9 out of 10. It's consistently seen as a top-tier growth compounder, really thanks to that exceptional financial performance, clear tech leadership, and a pretty packed schedule of potential positive catalysts coming up.
So it seems like it could appeal both to maybe shorter-term investors trying to play the Q3 earnings or upcoming product news, and also to long-term investors just wanting exposure to the secular trend of e-commerce growth.
I think that's fair. If we connect it back to the bigger picture, Shopify has repeatedly proven its resilience and its ability to innovate ahead of the curve. But the absolute key factor determining if right now is the best time to buy, it really hinges almost entirely on whether those crucial Q3 earnings on November 4th can meet or ideally beat the very high expectations already baked into the price. And alongside that, whether any of those speculative rumors of The big retail partnership, the fintech move, the next wave of AI tools actually materialize in the coming months to provide that extra fuel needed to justify the current premium valuation.
Right. And given that sky-high valuation premium, a premium that really demands continued growth rates of 30% or more, maybe the provocative question you should be asking yourself is this: how much more upside is realistically left if Shopify only meets, rather than soundly crushes, those analyst expectations? Sometimes when a stock is priced for perfection, simply meeting expectations can feel like a disappointment to the market. That's definitely something for you to mull over as we head towards that November 4th earnings date.
That perfectly frames the challenge and the opportunity ahead for Shopify investors.
Great insights as always. Thank you for joining us for this look into Shopify. We'll see you next time on Investing Dog Podcast.